BRP, the maker of snowmobiles and all-terrain vehicles, other outdoor toys, is radically cutting its earnings forecast by half. That's the earnings outlook for the year. It is now looking for a profit of only about $3 a share, down from the $6 to $7 it had been expecting. Let's get more from Stephanie Hughes of Bloomberg. The market not thrilled with BRP, Stephanie.
Definitely not, Andy, and that's to the tune of as much as a 9.5% drop in shares today. That's the biggest drop since November, and it put Toronto-listed shares among the worst TSX performers. And like you mentioned, this came after the snowmobile manufacturer dramatically cut its normalized earnings per share for the full 2025 year, basically in half. So they're now expecting a range of about $2.75 to $3.25 a share moving forward. Normalized EBITDA was also cut pretty dramatically. So analysts were weighing in today. TD's Brian Morrison said that the lower guidance guidance cut didn't surprise his team, but the magnitude of which certainly did. National Bank also echoed this sentiment, saying that the reduction was much more significant than his team expected. So just to look at it big picture, BRP had a pretty volatile year, and late last month, it was hit with two downgrades from analysts who were commenting on this slower than expected retail recovery. The company is also making a bigger bet on electric motorcycles, which were part of its 2025 lineup. Now, the challenge that it's grappling with is weaker consumer demand, and which could leave the company with higher than expected inventory levels. So a lot of the future success here might depend on this EV play here, Andy.
That's interesting. Yeah, they're trying to do this switch to electric vehicles at a time when demand is going soft. Bring on electric motorcycles, though, Stephanie. I'm no fan of loud bikes. Enghouse, the software company, what's the story there?
For sure. So Enghouse, those shares are down. They rose as much as 5.8%. That's the biggest gain since December. And the mapping software provider reported results after the bell yesterday that came ahead of what the street was expecting. It's basically an across-the-board beat there. So TD Cowen's Daniel Chan said he considers the results to be mixed for now, just given that his team has a few questions that the answers of which could provide either a more positive or a more negative outlook. Chan added that his team continues to believe that the company is well positioned to execute on its acquisition strategy. So it's a lot of moving parts for that company, but it seems like traders are liking what they're seeing.
And then finally, Northwest, the retailer in northern regions of Canada.
Yeah, it's the retailer that can apparently. Its shares are up 4.4% today, and that's briefly moving the stock to all-time highs today. And this is because the northern retailer posted an EBITDA beat and raised its dividend to 40 cents per share. Following the earnings report, it did get some price target increases from BMO, TD Cowen, and RBC. So all of that is working in tandem to give a lift to stock prices today. TD analysts said that they raised the price target due to early signs of a major economic stimulus and increasing consumer demand in northern communities. So they also argued that the tailwinds of this support payment is still in the early innings. So from their bet there, it seems like there's a lot more runway to go there, Andy.
Stephanie, thank you very much indeed. Always great to have you on the show. Have a wonderful weekend. Stephanie Hughes of Bloomberg.